All right, investors already under pressure on inflation and those Fed rate hike worries. But now geopolitical concerns are piling on. In a White House briefing in the last hour, National Security Advisor Jake Sullivan warning that Russia could potentially launch an invasion of Ukraine any day now and advised any Americans still there to leave immediately. Sullivan also said an attack could possibly come while the Olympics in Beijing are ongoing. Let's look at the impact on the markets. Let's start with the 10-year Treasury yield losing ground as investors flee to the safety of government bonds. The Treasury yield is now down 8 basis points, 1.95%. Wall Street's fear gauge, the VIX index, it's hitting its highest level since January 31st. It was at 31. Now it's backing off to 29 and change. Oil futures rising over 5%, now 93.60 the barrel. The U.S. dollar, that is strengthening on the invasion fears of Ukraine as well. And defense names are moving higher at this hour. Let's pull them up and talk more about this developing geopolitical crisis with the chief global strategist at JPM Chase, David Kelly. You know, I'm just looking at the plate that investors have in front of them. You've got inflation. Now you have the Russia tensions. Do we stand a chance? What do you do?
Well, I think the market could well correct more significantly because of this if we do have an actual Russian invasion of Ukraine, because that could disrupt global oil markets, global natural gas markets, could affect the European economy. But I think what you do is you look at valuations. I mean, the whole market isn't expensive. Large cap growth stocks in the U.S. are pretty expensive, but value stocks in the U.S. aren't expensive. International stocks in general are not expensive. Emerging market stocks are not expensive. So there are areas in the market that you can invest in and not be too exposed as a long-term investor, even if the market takes a hit from this.
So far this year, the S&P 500 is down about 7%. You say the market can potentially significantly correct if there is an invasion? I mean, what number are you looking at? What is the decline that you're looking at? How bad does it get?
Well, you can't predict that in any exact way. What you know is if you buy stocks for the long run, they're going to be more volatile, but in the long run you get better returns. That's the price you pay. So yes, you could see a significant correction,
right.
But again, you've got to really think about what you own here.
But going into the weekend, do you think investors might just take money off the table and say, let this all just play out a little bit before we jump back in?
I think some may, and a lot of investors invest passively. A lot of investors don't want to realize capital gains. So there are things that support the market here, but there are people who are going to time this and figure we're due for a correction, try and ride it down, make some money by shorting the market, and that could, of course, cause a more significant correction.
We got the consumer confidence number for February, so a current number early this morning. It's at a 10-year low. Investors are concerned primarily about two things: the rising cost of life, right? Inflation, that continues to be a worry. 7.5% is the running rate. And also economic policy that is contributing to it. Well, and now we're looking at oil prices popping because of this imminent potential invasion into Ukraine by Russia. Inflation's everywhere. It shows no sign of abating. What does the Fed do?
Well, what the Fed should do is take it easy. They didn't actually cause this bout of inflation. This bout of inflation was caused by both this administration and the last administration pouring more money into the economy than the economy needed during the pandemic. We didn't need those one-time checks. And what happened is a lot of that money ended up in the hands of people who spent the money at a time when there really wasn't supply. So you got too much demand, not enough supply, you end up with inflation. That's what happened. The Federal Reserve should gradually increase interest rates because they're too low.
Define gradual. Are you talking about 7 rate hikes this year, long and slow, like Bank of America and Goldman?
What I think they should do is raise 25 basis points every quarter, 1% per year. That's what they think they should do. I agree that they may go faster than that, but we've got to watch that one, watch this carefully, because the classic Federal Reserve mistake is to wait too long and then do too much. And that's what I'm worried about. They should have started raising interest rates a long time ago. They should have started reducing their balance sheet a long time ago. But at this point, you don't want to overreact, because this economy is actually more vulnerable, more fragile by the end of this year than it would have been, say, 6 months ago. And the Fed has to think ahead about whether the economy can take it, down the road.
So I think I heard you say 4 hikes this year, in your view.
That's what they should do. I do think they're more likely to go 5 or 6 at this stage.
Yeah, and they keep saying they're data dependent, but I ask you if we can trust the data, because it's so influenced by Omicron, right? And they get more data before the March meeting, which there could be the big bang there, the half point hike. They get I think, 2 jobs reports and another CPI print.
Well, that's right. And the data is being affected by that. And I do actually think inflation will ease during the year. But also, you've got to think about Ukraine now. Because if you do have an invasion of Ukraine, if you have a spike in oil prices, you've got a lot of uncertainty, big fall in confidence, big fall in the market, that might actually cause them to hold back.
So the Fed's going to hold back then?
No, we don't know. I think we'll know a lot more when we see how far Vladimir Putin is willing to push this sort of murderous campaign. Because we've got to take a step back. There's no reason for this at all. This is a terrible, terrible thing to do to the poor people of Ukraine. But let's see how far he goes. Let's see how far Europe and the United States react to it, and what that does to oil prices and what that does to natural gas prices. When we know that, I think we'll have a better idea of what the economy is going to do and what the Fed's going to do.
Well, reports are that Russia's actions could start as soon as Tuesday. So it seems like it's imminent now, and investors are trying to respond in the meantime.
Yeah, the administration's been kind of warning us that this is coming, but it's just very tragic for the people of Ukraine.
Are you worried about stagflation?
Not in the long run. I think stagflation doesn't persist for a long period of time. So you may have a period of time where inflation looks a bit high and the economy's in trouble, but the economy getting in trouble will kill the inflation. So it looks like the cure of one disease causes the other, so to speak. And so I do think we could have a bout where inflation's a little high, and then you could have slow growth or even potentially a recession in 2023 if everything goes wrong. But I don't think that stagflation is a sort of a long-term phenomenon here.
What about the R word, recession?
I think the risks are rising in 23. I still think it's less
in 23.
Yeah, I think we can probably we've got a lot of momentum in this economy still this year. We've got all the reopening momentum, people trying to get back on airlines, go to hotels, restaurants. We've got plenty of savings. We've got a capital spending cycle. We've got such a demand for workers that businesses are anxious to try and find a way of getting more equipment in place, better machines to try to deal with the lack of workers. There's a lot of momentum, so it's very hard for the economy to peter out or to go into recession right now. But by the end of the year, this will be sort of waning. And then if you've got higher rates and you've got higher oil prices, you've got less consumer confidence, then you could be in more trouble.
Okay. All right. So we should be okay this year. Next year, you're a little bit worried, and the Fed plays.
Yeah, but think carefully about what you have in your portfolio.
Yeah.
Have stuff that's good value. Don't have stuff that's overpriced.
And quickly, just if you were making recommendations right now, what would they be for our viewers?
A little bit overweight U.S. value stocks, a little bit overweight international stocks in general. Be careful about the mega caps. Be careful about the bitcoins and the SPACs and the more speculative stuff. This is not a time to speculate.
David, we appreciate you, especially on a day when the Dow is down 406 points.